All right. So thank you for allowing me some time today to talk about OneAmerica and asset care. And I'm also going to talk a little bit about our annuity care products as well. So first thing I want to tell you a little about OneAmerica, just real quick. You see our building in the middle of the slide. OneAmerica has been in the long-term care business. This is our 34th year in the long-term care industry with our asset care products. We're very proud of that we've been in this marketplace for quite some time. We've been in the insurance industry since 1877, so we have some tenure behind us as well. We are a mutual company. We're A+ rated with AM Best, AA- with Standard & Poor's, which is the equivalent of an A+ rating, so we're proud of our ratings. And our Condex score is 96. That puts us in the top 7% of all life insurance companies in the United States. So we're very proud of our financials, and you should feel very good when you place a policy with OneAmerica that we're going to be there not only today, but in the future. We're strong financially, and we do the right things for our clients. So let's talk a little bit about asset care and annuity care. I want to give you a few things to think about. So when we think about the concept of long-term care and funding it with an asset-based product, people generally have some moderately invested money, they have some aggressive money, and they have some conservative money. And what we want to be able to do is just take a little bit of that moderate or conservative money and leverage it for the purposes of long-term care. So we take a little bit of that and we can turn it into, with the asset care, we can turn your funds and provide you a death benefit. Well, not only a death benefit, but we can also provide long-term care benefits. And something that's unique to OneAmerica, not only do we have long-term care benefits on our whole life chassis, but we offer something that only one other company offers, which is lifetime coverage. We are the only company that has lifetime coverage on a asset-based product. We have one competitor on the traditional side of long-term care that offers lifetime coverage. So we're very proud that we offer lifetime coverage. Many of the sales that and the policies sold is because the client wants lifetime coverage. Where lifetime coverage can be so helpful is, think about a couple. We never know how long either one of them may need long-term care. And with lifetime coverage, you don't have to worry about if one goes on claim and uses it for a fair amount of time, that the spouse, all of a sudden, when the person using the long-term care passes away, and fast forward some years later, now the spouse needs long-term care, they might not have any benefits left, or they might have a very limited amount of benefits. With our lifetime coverage, you never have to worry about how long either one or both should need long-term care. We're going to be there forever. For as long as either one or both need long-term care, there's a benefit available to them. So let's talk the concept of how our product works. And this works really for both our life-based product and our annuity-based product. Some of the numbers on the slide, these are, and Victor, correct me if I'm wrong, that some of the folks on the call could be from outside of California and some are in California. Is that correct?
Yes.
Okay. So I'm going to be talking about, on these slides, these are geared more toward out of California. I'll point out a couple of differences. Inside California, the product works a little differently. When we go to run the quotes, I'm going to do California quotes. So I'm going to kind of go back and forth between the two. And you'll see that there's the products aren't that different, whether you're in California or outside of California. So on the left-hand side, we have the base policy. Now, the base policy is either a life insurance policy, so a whole life policy, or it's an annuity. So that's our base. And we have lots of ways you can fund it. You can use a single premium with cash. You can pay on an annual basis. Outside of California, we offer a 5-pay. Inside California, we do not have a 5-pay. But and then all across the country, we have, including California, we have a 10-pay, we have a 20-pay. The pay to 95 is for those folks outside of California. inside California, it's actually paid to age 100. So if you reach age 95 outside of California or age 100 in California, from that point forward, you have a paid up policy. We can use qualified money, both in California and outside of California. Works a little different outside of California than it does in California, but the bottom line is we can use qualified money. Now, that doesn't mean that the client won't pay taxes on these dollars. We're going to spread the tax burden out when they use the qualified dollars in California. The money comes out over a 20-year period of time, so they would receive a 1099 over a 20-year period of time, and that counts toward a distribution. So that can be very helpful for clients that either before they get to 72 or once they're 72 and they have to start taking distributions, or if they're before 72, to help minimize the distributions they're going to have to take in the future. We also can use non-qualified annuities for a 1035. We can use cash value from a life insurance, and we can use income from a SPIA or a single premium deferred annuity. So that's how we can use from a funding standpoint on both asset care and on annuity care. Now, on the right-hand side, we call it our continuation of benefits rider. The continuation of benefits rider can be one of two things. It can be limited, and limited means it would be on the asset care, it would be double the dollar amount for the life insurance for the purposes of long-term care, and as well as we have lifetime, so where it never runs out. Really, the same thing holds true with the annuity products. A couple little variations there, but for the most part, it works very similar. On 2 of our 3 annuity products, we do offer lifetime unlimited coverage. From a funding standpoint, we can use single premium, we can use cash, recurring premiums. Once again, 5 pay not available in California, 10 pay, 20 pay available, pay to 95 outside of California. In California, it is up to age 100. The continuation of benefit rider is a 7702B product, which means it qualifies as qualified long-term care under the federal guidelines. That can be a deductible premium for business owners. And I'm going to take you through that after we talk about product. I'll talk a little bit about the tax deductibility and how that can help you. I've also already sent to Victor. We have a tax guide. We also have a handy one page. It's actually front and back, but it's a one-pager. I sent it to him as both of those pieces, and I've asked Victor to send it out to everyone today after my presentation, so you have that as a reference tool. But there is some great tax deductibility that can be found. So let's talk about how the policy works. Now, this is for couples. We can sell this policy as a joint policy. And what that means is that I can take a husband and wife, and I can sell them one policy that they both can use for long-term care. So in that case, we offer a 33-month acceleration of the death benefit at 3% per month. So just real quick, easy math. If I had a $100,000 death benefit, it'd be $3,300 of monthly long-term care benefit over 33 months. Once I've used up all my death benefit, then we go into the continuation of benefit rider. I'll come back to that in a minute. We can also offer a 50-month base at 2% acceleration of the death benefit. And then for the continuation of benefits rider on the asset care, so on the life-based product, I can either double it. As you see, I can go to 50 months or I can go to lifetime. On the 33 months, I can double it and have another 33 months for a total of 66, or I can have lifetime. Then when we talk about single folks, they can buy a 50-month plan. They can buy a 33-month plan. Single folks can also buy a 25-month plan with a 4% acceleration of the death benefit. Now, this is specific to California to everywhere but California at the bottom. So we offer a 25-month plan. as the continuation of benefit rider for a single person across the country, including California. Outside of California, we also offer a 50-month plan that you can add to the 25-month plan. And then everywhere, including California, we can offer lifetime coverage. So lots of ways that I can mix and match this and find the perfect benefit for my client and the right budget for that client as well. All right. So single premium, we sell our single premium product about 15 to 20% of the time. We sell our qualified money also about 15 to 20% of the time, and a little over 60% of the time, about 65% of the time, we sell an annual pay, which is either a 5-pay outside of California, across the country, a 10-pay, a 20-pay, or an annual pay to age 100 in California or to age 95 outside of California. So with that, I have a slide that says questions. I can take a couple. If anyone has a question right now, I can take that, or I can go into the rate calculator where I'm actually going to build some policies out, some quotes, and show you how the policy actually works. Anybody have any questions? Okay. Bear with me just a second while I bring up our rate calculator.
Hi, I do have a question.
Okay.
Yeah, I heard like a few weeks ago, and OneAmerica offered rate upgrading. So in the same person, if they qualified for after the exam, they are going to offer the better rate for the same person. Is this still ongoing?
I'm not sure if I understood the question. So
okay, the question is, so the rating, see if the client after the exam, physical exam,
yes,
okay, if they approved by standard or whatever, and I heard it's going to he or she will get a better rating and some kind of a promotion. So in other words, the client can pay less than he should be. Is this
okay,
still?
all right. So back in, I'm trying to think when we did it. Back in December, we had a rate change where we lowered the premiums.
Yes.
And for those, and so if they applied during that time, when we issued the policy, there was a period of time that we were offering the lower priced product for those clients. So we've now lowered the pricing.
So it's still ongoing, right?
Yeah, we have new pricing that's lower than it was 6 months ago, 5 months ago. So we do have lower pricing today.
So there's no cutoff time yet.
No, it is our new pricing.
Oh, I see. So and also, is that save aging still work?
Yes. So the save age is within, as long as we receive an application within 30 days of the client's birthday, we will save age.
So what if the client are past the birthday already, but still within 30 days? Can that client be save aged?
Yes, as long as we receive an application for that client within 30 days of their birthday, we will save age.
Oh, okay, that's good news. Say for example, someone birthday is January 15th, for example, and now if he applied now, is within 30 days, right?
It's less than 30 days, correct.
So yes. It's qualified with that a save age.
Correct.
For the birthday.
Correct. Yes, correct.
Okay, sounds good. Thank you.
All right.
That's all I have.
You're very welcome. Okay, now let me ask you a question, because you have your phone on live right now, or your computer. Do you see my page where it says it's OneAmerica and it's got a map on the right-hand side?
Yes.
Okay, good. Everyone sees it then. Thank you. All right. So I went to our website that is not password protected. And I'd love it if you could just write this down. It's the website is assetbasedltc.com. ASSETBASEDLTC.com. So that's a website that you all have access to right now. It's not password protected. The password protection that we have for it is right here. Yes, I'm a financial professional. No, I am a consumer. So you're all financial professionals. You would click on that and you can access all the materials here. So I want to point out a few things before I build my first quote. So right here is a cost of care survey. So if you're working with a client in whether it's in your area or in another part of the country and you're not sure what the costs are, you can click on this cost of care survey and it can help you with understanding the price of both home health care, assisted living, nursing home care. Great resource. Right here is some information that we've recently done with kind of researching the market. Great opportunity to learn a little bit more there. Here's our website. Here's our sales desk, our marketing toolbox, lots of different materials there. Once again, easily to access, just hitting get the latest info. But what I really want to take you to is this right here. Calculate benefits now. When I'm going to click on this, and now it's going to ask me, because I hadn't already clicked, yes, I'm a financial professional. I click here, and now I'm into the calculator. This is a tool that you can run from your telephone. You can run it from a tablet. You can run it from your computer. It is a web-based tool, but what's unique about it as a web-based tool, you know, if you run it from your phone, from an iPhone or an Android phone, you know, there's a lot of websites you go to that when you're using it with your telephone, that it doesn't recognize the equipment you're using. And so you have to do a lot of scrolling left to right, up and down. Our web tool recognizes the type of device you're using and therefore will work much easier if you're using a tablet or even more importantly, a phone. Everything is in just up and down so you don't have to scroll right and left. It's much easier to use. So I'm going to run a quote. The first thing I'm going to do, I'm going to run one of our annuity care quotes. I'm going to run an annuity care 2. I'm going to use the state of California. And the annuity products are the same in California as they are outside of California. I'm going to run it for myself. Oops. What did I do? Sorry. Obviously, I hit a wrong button. All right. And I'm going to make myself 75 years old. I'm not 75, but we'll say I'm 75. I'm 58 for real. All right. So I'm going to show you what $100,000 can do for this client. So I took $100,000. I put it into the Annuity Care 2 product. I can take that $100,000 and I can give it little over 2.5 times leverage for 60 months. So let's break it out. I'm going to show you the PDF of what you would actually share with your client. So here's the PDF. I'm going to download it. And I don't want to do that. I'm actually going to save and download. That'll be easier for you to view it right away. All right, so here it is. 2-page output. Very simple. So here we've got Annuity Care 2, one of our 3 annuity products. Just a repeat of the information I put in. Here's my client's name, age, state of California. Here's the premium, $100,000. I turned that $100,000 into $251,815 for long-term care over a period of 60 months. Here's my single, and if they're more of a visual, it's in a bar chart. Same information as above right here, $100,000. Here's our annuity. Here's our continuation of benefit rider. So the first dollars being spent is your $100,000 annuity. The next $151,815 that comes out of this policy is your leverage. So it's the leverage that you bought for this premium. So this policy would pay out $4,196 per month for long-term care services. For the first 24 months, if you look down here, 24 months, that's how long it takes to wipe out this annuity at $41.96 a month. So after 24 months, I've used up all of the annuity dollars. Then I go into my continuation of benefit rider, still at $4,196 per month for an additional 36 months. So this is a 60-month policy. So right here, 60 months for long-term care. So I took $100,000 and I gave my client just over 2.5 times leverage with their money on $100,000. That's how our annuity products in general work. Let me take you down to the second page. So here is our $100,000. Here's our accumulated value. So if they were to pass away, they would receive the accumulated value. In the first year, $100,677. Then it drops, and it's going to continue to drop a little bit. But keep in mind, in year 5, their value has dropped $5,725. Okay, so just a little over $5,000. They had a $250,000 benefit. In the first 5 years, it cost. Yes?
Could you make it bigger? Easier to. Oh, yeah. Thank you. Thank you. Yeah.
You're welcome. All right. So if in 5 years the client passed away, they had a long-term care policy in force for $251,815, and all it cost them was $5,725. That's a very inexpensive long-term care policy for a 75-year-old male. So the annuity products are a great way to go for certain clients. Let me talk about the 3 times that it makes most sense to use our annuity products over the asset care, which is the life-based products. The first one would be age. Generally speaking, at about 70 to 72 years old or older, the leverage is better on our annuity products than it is on the life products. Additionally, on 2 of our 3 annuity products, we can go all the way up to age 85. On this product, we can sell it through age 80. Okay, so one is age. The second opportunity to use this product would be because of underwriting. This is an underwritten product, but there's less underwriting on the annuity product than there is on the life product. And there are some cases where a client may not be eligible for the life product, but they could qualify for the annuity product. And then the third one is really 3A and 3B. 3A is people using cash. About 50% of our annuity sales, people are using cash. The other 50% are using existing non-qualified annuities, and they're doing a 1035. You can 1035 from a non-qualified annuity into this product. The advantage of doing that is if you use a non-qualified annuity, and let's use this example of the $100,000. And the client originally bought an annuity with $40,000. And they've had it for a while, and it's grown to $100,000. And they 1035 it to OneAmerica. And in any other annuity, if they were to cash it in, they would have to pay tax on the $60,000 of gain. In our case, because they 1035'd it into a OneAmerica annuity, if they need to use the money for the purposes of long-term care, all $100,000 comes out income tax-free. So you can save your client thousands of dollars if they have an existing annuity and they use it for long-term care after they've done a 1035 into our product. The money comes out income tax-free. So it's a great play for a client that has an old annuity with gain to be able to withdraw that money income tax-free when and if they have a long-term care claim. The last thing I want to tell you about our annuity products is you might be somebody that's pretty savvy with annuities. I don't know all of you on the phone. You may have clients that are pretty savvy with their annuity products they have. This is not meant to be a growth vehicle. So this is not where you're not selling this annuity because you're going to be able to grow their money. You're buying this or offering this to your clients because it's a way to leverage their money to protect all the rest of the money and assets they have against the risk of long-term care. So if you're looking for an annuity that's going to grow significantly, this is not it. If you're looking for an annuity that's going to be able to provide great long-term care protection, one of our 3 annuity products would be the way to go. Okay. Questions about either page of the illustration and how this annuity product works?
So
Okay.
for the non-qualified annuity, so how about the additional benefit from the long-term care? For example, you just mentioned the about 100,000 is totally tax-free for the non-qualified annuity. Yep. What about the additional benefit from the long-term care?
Good question. And I apologize I didn't mention it. The continuation of benefit rider on all of our products is income tax-free. So using this example, they use up the 100,000, 60,000 of it because it was a 1035 as gain. That all came out income tax-free. So the entire 100,000 here comes out income tax-free, or actually it comes out here. The next 151,815 out of the continuation of benefit rider also is income tax-free. So the entire $251,815 is income tax-free when it is used for long-term care.
Wow, that's great.
Yeah, it's great benefit, great feature. All right, now let's switch gears a little. Actually, I'm going to show you one other thing. So I can also add a spouse. So if I want to add a spouse, and let's say the spouse is also, let's make the spouse also 75. So the same $100,000. And now I have a $221,000 total benefit amount for long-term care versus $100,000 that we saw before. I'll create the PDF real quick. A second. Let's download it. And I'm going to blow it up a little. All right, so here's our same $100,000, but in this case, we added a spouse. So the benefit, it's a little less benefit. Why is it a little less benefit? We just doubled our risk. So that's why the benefit's a little less, because now we don't have one person insured, we have 2 people insured. And in this case, it also changes the base, went from a 24-month to a 30-month. So they have a total now of 66 months. So 5 years and 6 months of total benefits payable at, here's our base, here's our continuation of benefit rider. Most important right here, our monthly our monthly benefit went to $3,353. That's what each of them could access at any time for a total of 66 months. So total of 66 months are available to the clients. It doesn't matter whether one of them uses all the benefits or the other, or they're both on claim at the same time or at separate times. They have a total of 66 months of benefits paying out at $3,353 per month for up to 66 total months. Here's once again, the cash surrender value, the cost of insurance. Here's our benefit, $40,236 every month or every year for the client. Okay. Questions on the joint? Okay. I'm going to go.
I have a question on the joint account.
Okay.
If someone paid by cash, and if first of all, can they pay monthly?
So on the annuity product, they cannot.
No, I mean the assets care.
On asset care, they can. Actually, on the annuity product, not on this particular annuity, but they can pay. They have to single pay the base, but the continuation of benefit rider can be paid as a 10 pay, a 20 pay, or an annual pay on the other two annuity products that we offer. On asset care, they can pay it as outside of California, a 5 pay, which can be done monthly. Everywhere, including California, they can do a 10 pay, 20 pay, or annual pay. And those can all be done on a monthly basis.
Okay.
Both the base and the rider.
Okay, sounds good.
The probably one of the another great advantage that OneAmerica brings to the table is that we have more ways to fund a long-term care policy than anyone else out there. And I'll share that with you right now. I'm going to make this a joint policy. And I don't even have to put names in, so I'm just to move along a little faster. I'm going to make this a 57-year-old couple. So 57-year-old couple, and we want a monthly benefit of $6,000 a month. That's a pretty common monthly benefit. So I've got husband and wife, male 57, female 57. They're both non-smokers. This is an asset care, which means it's a single pay policy. So they write one check and they're done. So I'm going to calculate it at $6,000 a month. So if they were to write a check to OneAmerica for $127,000, it would create a $200,000 death benefit at $6,000 of monthly long-term care for life. Let me go to the PDF real quick. Okay, so here it is, husband and wife. Here's our premium, $127,588, and it's a death benefit of $200,000. So what I like about this particular illustration, so I'm showing this couple that if they write a check for $127,588, they immediately have a $200,000 death benefit. This is a second to die policy, by the way. Okay, so it's at the death of the second person, the death benefit would be paid out. If they never use this policy for long-term care, their beneficiaries would receive $200,000. If they need long-term care benefits, they could at a minimum, I shouldn't say that. They can start receiving long-term care benefits at any time in the policy. The long-term care benefit is $6,000 a month. So right here, $6,000 a month. Once they've exhausted the $200,000 death benefit for long-term care, they then go over here into the continuation of benefits rider. That continuation of benefits rider never expires. So as long as either one or both need long-term care, they would be paid out $6,000 a month for as long as either one or both of them need long-term care. So we'll get our $200,000 back in the way of a death benefit or in the way of a long-term care benefit. Let's take a little different example. Let's say I go on claim, and I'm on claim, just to make it easy on me math-wise, I'm on claim for 10 months. So that means I use $60,000 of the $200,000 death benefit for long-term care. So there's still $140,000 of death benefit remaining. My wife and I die after 10 months of long-term care. My wife lives another 20 years. She never needs long-term care. And upon her death, the balance of that $140,000 of death benefit would be paid out to our beneficiaries. So I can look your client straight in the eyes and promise them, excuse me, one of three ways your clients will receive $200,000 in benefits. They'll receive it, or their family, I should say, would receive it in a death benefit. They would receive it in the way of a long-term care benefit, or a combination of some long-term care and some death benefit. Total of $200,000. So they take $127,588. I'm guaranteeing them a $200,000 return. Guaranteed. Okay. Let's continue on. Let's take a look. So here's the premium. So single pay of the premium was $77,626. The other $49,962 paid the continuation of benefits rider, and that covered the total of the $127,588. So here's the life premium. Here's the long-term care premium. Let's take a look at the cash surrender value. So I want I want you to jot down these two numbers for me, if you will. So the $127,000, that's our premium. The cash surrender value in year 10 is, or 15, is $102,228. Okay. Keep those two numbers in mind. $6,000 monthly benefit. Okay. $200,000 death benefit, $72,000 a year, unlimited for long-term care. I'm going to make a change to this policy. And the change I'm going to make to it is I'm going to change one part of the premium. So we're single paying the base. I'm going to change the base now to a continuous pay, which means they're going to pay in California. They will continue to pay this premium until age 100. At age 100, it becomes a paid up policy on the continuation of benefits rider. Okay, so now I'm going to go right to the PDF. Okay, let me blow it up. Now, I didn't write the two numbers down, but I remember it was about $125,000 was the single pay. Now you can see the first year premium is $80,675, okay? Because we're only single paying the base. Still the same $200,000 death benefit. So here's our initial premium, our death benefit, continuation of benefits rider, lifetime still. Everything's the same, but now we have an annual premium. So our initial premium first year was $80,675. Of that, $77,626 paid the base. They have a continuous pay premium of $3,049 on the continuation of benefit rider. Okay, so they're going to pay $3,049 each year for the rest of their life. They'll pay that premium. But the upfront money is much less. And if they are a business owner, which we'll come back to, this potentially could be deducted from their federal income taxes, 100% of it. Okay, I'll come back to that toward the end. Now here's where I want you to really take a look again. So remember we had, it was about a little over $125,000 premium. First year, our premium was $80,000. If we go to the 15th year, our cash surrender value, somebody remind me, what was the cash surrender value at year 15? Did anyone write it down?
I think similar with this 102.
It was the same 102?
Similar, not too much different.
Okay. But the difference is the amount of premium that they've spent. Because they started out with $80,000. They were paying $3,000 a year. This is much less than the $125,000 they put in originally. So the cash surrender value tends to be stronger from day one, because the cash surrender value only applies to the base policy, the life insurance portion. So single paying the continuation of benefit rider, there's no cash surrender value in that part of the premium. So some people like this because the cash surrender value is stronger than it is if they single paid the continuation of benefits rider. Questions on how we paid it other than a single pay? I could also So it was $3,049. I could also do this in 10 years if I wanted. And keep in mind, outside of California, I could do a 5-pay. So if I wanted to pay it off in 10 years, it would be $6,476, and I'd have it paid off in 10 years. If I wanted to pay it over 20 years, I could do that. And the premium would be $3,906. So lots of ways I can pay that continuation of benefit rider. Now, let's say your client says, well, I don't have the $80,000 in the first year. That's fine. Well, let's change it up a little. So I'm going to change this from Asset Care 1 to Asset Care 4. The difference between Asset Care 1, 2, 3, and 4, and I'm only going to talk about Asset Care 1 and 4 today. Maybe I'll touch on Asset Care 3. The only difference between the 4 products is the premium, how they pay the premium. This is our single premium. This is for non-qualified annuities, but we're better off using our annuity care products. It's a better leverage. This is using qualified funds. And this is a client that says, I want to pay it over 5 years outside of California. I want to pay it over 10 years, 20 years, or to age 95 out of California and in California to age 100. So let's do an Asset Care 4. Same benefit amount. And let's calculate, still lifetime coverage, continuous pay. So now the premium is $7,763. Look at the death benefit, still $200,000. So now I'm going to create a PDF. Blow it up a little. Okay, so here, same ages. Now the premium, see how small the premium is? $7,763. Still a $200,000 benefit, death benefit. Still lifetime unlimited. But the difference is we're going to pay a premium every year up until age 100. In outside of California, it'd be up to age 95. So if we look at the benefits, there's our premium, there's our death benefit, here's our monthly long-term care benefit. Here's the premium for the base. Here's the premium for the rider. So it'd be $3,049 deductible for business owners. For every one of you, this could be a deductible expense because you're all business owners. We'll talk a little bit more about that, as I mentioned, in a few minutes. Here's our cash surrender value. You see it's very small now because they're only putting a little bit of premium into the policy every year. So the cash surrender value is much smaller. Death benefit's still the same at $200,000, still $72,000 annually in long-term care benefits. So it works the same, just a different way to pay. Now, one other thing I want to mention is it's $6,000 a month per person or $12,000 monthly if they're both on claim simultaneously. Let's say my wife and I go on claim simultaneously. Okay, we both can draw $6,000 a month, right, per person. However, this death benefit over here is 33 months. You see it right here. It accelerates the death benefit 3% for 33 months. So if my wife and I both file a claim simultaneously, we'd be eligible to receive up to $6,000 a month each for our long-term care services. However, that 33 months, that death benefit, we're going to use it up in 16 and a half months because we're both using a month of benefits every month. So it's going to be used up twice as fast. So in 16 and a half months, we will have wiped out the death benefit. But that's okay. Why? Because we have lifetime unlimited long-term care benefits. So that $6,000 a month that we're each receiving, we can receive for an unlimited period of time. It will never, ever run out. Here's another thing that's very important to consumers. The premiums are guaranteed to never increase. This is a non-cancelable policy. It will never increase. The premium that I'm showing you, this is true on all of our products, no matter how you pay the premium, this premium of $77.63 will never change. It will always be $7,763, no matter what happens. that is the premium your client will pay. Questions on anything we've talked about so far?
I have a question about the couple. So what about two couples' health condition are different? So one person qualified, and actually if both people qualified, but one in standard, but the other one below standard. So what's going to do? Which rating you're going to use, or you use?
Great question. So I'll get to your answer in just a moment. I'm gonna elaborate on it a little bit first with the answer. So first thing is they both have to my wife and I each have to qualify on our own. Okay. So with a lot of second to die life insurance policies, you know, if one person's health isn't so good, sometimes they'll approve the person because it's a second to die. We both have to be approved on our own health history on our own. So if I have some bad health that doesn't meet our underwriting guidelines, I would be declined. Then we would turn this into a single life case for my spouse, for my wife. If I am table rated, and our table ratings, every one of our insureds is automatically, our pricing is set up at table rating 4. So anyone that's 1 through 4 is preferred. The difference between preferred and non-preferred or standard is one thing and one thing only, right here, smoker. So if you're a non-smoker, you're preferred with OneAmerica. If you're a smoker, you become standard. Within both the preferred and the standard rates, we can table rate individually a client a table rating 5, 6, 7, or 8. Excuse me. If I'm table rated a 6, for example, that will age me up, and it will recalculate the pricing for my wife and I as a couple. But it's based on, it will change my age, so it would make me more expensive. My wife would stay the same, and then they would come up with the new premium based on my age and my wife's age, current age. So that's how we handle table ratings. We table rate about 7% of our insureds receive a table rating. So it's a pretty small percentage that receive a table rating. We don't do table ratings on annuity care. It's only on the asset care products that we can table rate a client. Is that, I know I went very long on that answer. Does that answer your question?
Yes, thank you. Very clear. And I have one more question. Question about the claim. Is that a claim is reimbursement based, first of all?
Yes, these are reimbursement policies.
Okay, then if reimbursement case, say for example, this one monthly coverage like 6,000, then people need to provide the invoice or whatever they use the 6,000. What if they only use 5,000? They cannot get coverage for 6, right?
Correct. But remember, it's not use it or lose it.
Okay.
And think back to my example I gave earlier. So let's use a new example. So let's say I go on claim and we'll use 5,000 a month. I have 6,000 available, right? I have 6,000 available, but I only need, my cost is only 5,000 a month. And I'm on claim for 10 months. So I spent $50,000 on my claim and I died. Fast forward, my wife lives another 20 years. She never files a long-term care claim. There's still $150,000 of death benefit remaining because I only used $50,000 for my claim. Our beneficiaries would receive $150,000 remaining. So that's where I go back to. It's not use it or lose it. If you never use the benefits for long-term care, that's where the death benefit comes in. If you only use some of the benefits for long-term care, the balance will be paid out in a death benefit. So at a minimum, this couple, either for long-term care as a death benefit or long-term care and a death benefit, will receive, or their beneficiaries, if part of it's a death claim, will receive $200,000 at a minimum on this policy. Okay.
I have a question. So do they need to go to a licensed place, or they can stay at home? And do they need to use the licensed people take care of them, or they can use a friend, a relative or family member take care of them?
Okay. So I'm going to give you two answers. I'm going to give you a few answers. So the first thing overall is this policy will pay for home care, assisted living, nursing home care. All long-term care policies pay for home care, assisted living, nursing home care. They all pay for those services.
Okay, good.
In California, I'm going to be very specific. In California, other than a family member, you can hire whoever you want to provide the care for you at home. And that's by law in California. All policies will pay for what's known as informal care. So I can hire my next door neighbor, or I can hire whomever I want. Our policy does not reimburse for family members. Okay. Outside of California, the policy will pay for licensed professionals and unlicensed professionals that work for a home health care agency. So if it's a non-professional person, they have to work for a home health care agency. Once again, we don't pay for family members outside of California. Okay. Answer your question?
Yes. Yeah. So California seems to have more advantage, right?
A little bit of an advantage, yes. And that's something that's been around. So what I didn't mention about myself, I've been in the long-term care industry. This is my 37th year. And 1994 was when California implemented a law that stated that you had to pay for informal care providers. We are the only state in the country that mandates that.
Okay, so if like the policies, if bought in California, but if the claim moved to a different state, so it's still follow California law or follow the residence law?
Yeah, the policy will always follow the state laws in which it was purchased. So if you purchase a policy in California and you move to New York, New York's a bad example, you move to New Jersey, it will still pay the same benefits as a California policy. So it will always follow California law when you buy a policy in California. Whatever state you buy it in, it will follow the regulations of that state, no matter where you're using it for long-term care.
Okay, so another question is, if like a Cam is living in New Jersey, is that he can come to California to buy the OneAmerica care?
No, the only way that they can buy a policy outside of their state of residence, they must own another residence in that state.
Okay.
So if you have a client that lives in California, well, let's use New Jersey. You have a client that has their primary residence is New Jersey, but they also own a house in Malibu out at the beach in California. They own a second residence. They could use that residence as their state in which they're buying the policy, but they have to have a physical residence that they can show they have a residence in that state.
Okay, so they cannot considering their daughter or son's house as the residence?
No, because that's not their residence. It really needs
so
to be.
The add the earning, right?
They need to show that it's actually their residence.
How to prove? Do they need change their driver license to that state, or not necessarily?
Not that, but we may require showing a power bill or a water bill, something showing that this is their second home or another one of their residences.
Okay.
Okay.
What about another question about the claim? What about someone purchased this policy in California, but later on they move to another country? Can they still get a claim?
Yeah, so we do have international coverage benefits. In California, we pay 100% of the monthly benefit for 12 months in a nursing home only outside of the United States. Outside of California, the products we sell outside of California, we pay at 50% of the monthly benefit in a nursing home only up to 48 months. Now, this question comes up quite a bit, and I please, I don't mean to offend anyone on the phone. I am born and raised in the Bay Area. I have many friends that are in the Asian community, and growing up in the Bay Area, we have a very large Asian community. This question comes up all the time. It also comes up in the Hispanic community because we have a lot of Hispanics, from Mexico and other Central and South America. So this question comes up quite a bit. And my answer to this question when it comes up, because people believe they're going to move back to the country they may have immigrated from when they get older, or if they need care. And I like to ask two questions, maybe three questions. The first question I'll ask a client that brings it up that says, oh, we're going to move back to China where we immigrated from. Okay, great. So I ask them this question. Do you have any grown children? And most of the time the answer is yes. And they say it with a little bit of smile on their face. Then I ask them if they have any grandchildren. And then they answer with a much bigger smile, yes, I have grandchildren. And I simply ask them this next question. So my third question is, so if you need long-term care and you move to the country you immigrated from, that means you may never see your grandchildren again when you need long-term care because you've moved to another country. Is that something you've thought through, that you're going to leave your grandchildren? And most people will say no. The intent of our international coverage benefit and every other carrier that has international coverage, and I know people at the executive level at every long-term care company because I've been in this industry a long time, the intent of the international coverage benefit is not so you can move back to a country you immigrated from to receive long-term care for the rest of your life. The point of the international coverage benefit is really to be able to provide some benefits to those clients that are visiting their family and friends in a foreign country. Something happens to them. It has a benefit there that they can use so they can get healthy enough to get back on a plane to finish out the care that they need in the United States. So that's a long-winded answer. I apologize for that, but I wanted to be very clear on that answer as far as how people really use the international coverage benefit and what it's really meant for. That help?
Yeah, fair enough.
Thank you. All right, so now I'd like to, bear with me just a minute while I look for a document. All right, let's talk a little bit about taxation and how this can, how you can deduct some of the premiums from your federal income taxes. Okay.
So can I ask you a question about when you before hitting the calculator and
yes,
right above that it says like 36 months, that why when after calculated then it shows either 60 months or 66 months?
Okay, so let me go back here. So on the calc, was it when I was showing the asset care or annuity care?
Annuity, maybe annuity care.
Yeah, so on annuity care, the base is 36 months.
Yeah.
I'm sorry, it's 24 months. The rider is 36 months.
Right, the rider, right.
Yeah, so the rider is always 36. If it's a single person, the base is 24. If it's a couple, then it is a 30 months. So I'll show you real quick. So here is the base, 30 months. The continuation of benefit rider, 36 months. If I change this.
The total is 66. Okay.
Yes, if I eliminate this person and just go a single person now, single life, now you'll see it's 24-month base and the rider is still 36.
Okay, so that's how the total comes out. Okay.
Right. Okay, let me share with you, if I may. Let's talk tax deductibility real quick, and then I'll get you off the phone because I'm sure I'm over time. All right, so let me see if I can make this a little, I don't know if I can make this bigger. Let's see if I can. No, that's not what I want. Well, hopefully you can read this. Oh, here we go. All right, so there is some tax deductibility. If you're anything other than a C Corp, anything other than a C Corp, you can deduct these dollar amounts based on your age from your federal income taxes. So we were using a 57-year-old couple. So that means that couple can deduct per person, if they were a business owner other than a C Corp, $1,790 per person from their federal income taxes for the purposes of long-term care. Okay, so that's the continuation of benefit rider premium, up to $1,790 per person. If they are a C Corp, see if I have C Corp on this page, might be on the other page. If I'm a C Corp, then it is 100% of the cost of the continuation of benefit rider with no dollar limit. So it's 100%, okay, that the employer can pay for its employees, including the business owner. For C Corps, they can discriminate. So if I want to provide it to myself as the owner and my janitor, I could do that. I can discriminate and pick by job classifications who I'm going to provide this long-term care benefit to. Once again, it's only the continuation of benefit rider. Last thing I also want to point out, if you have clients that have an HSA, you can use HSA dollars to pay the continuation of benefit rider. The HSAs, same dollar amount can be used from an HSA based on using the age-based limits. So a couple ways that you can use the continuation of benefit rider premium and deduct it or use HSA dollars to pay for it. Okay. Questions for you, for me before we end the call, because I know I'm up against the clock. Oh.
You're talking about HSA. Is the HSA has a limitation? Like if you don't use that for the current year, can you use next year?
No, it follows that age-based limits. So it's always going to follow the age-based limits for an HSA.
Yes, follow what limit?
Age, what they refer to as the age-based limit. So it's this chart right here. So based on your age, this is the maximum you can use from your HSA to pay for your long-term care.
My question is, if you open the HSA account, and then you need a fund to the account first, right?
Yes.
And if you found that, if you're funding to that account, but you didn't use whatever you funded, is that a balance can be used next year?
Yes.
Yes. Yes, up to the age-based limits, though.
No, that's a roll over the unused balance to the next year always. So right. HSA, you can use at any time, whatever your balance is.
Okay, sounds good. And what about, but you will deduct whatever you contribute for that year, right?
Yes, each year you just deduct whatever you contribute in that year. Yeah.
Okay, and look at this on the screen you shared on this table. Is this amount applied to the base and continue COB, both?
No, for the HSOA, you just can contribute based on the tax limited.
I know, but yeah, there's another question. There's a different question. This is not a HSC question. And for talking about this dollar amount, people can deduct. So people can use this amount to pay the long-term care, OneAmerica long-term care, right? Is this can apply to the base amount and COB, or only apply to
no,
COB?
only COB and limited by the tax deduction amount.
Correct.
Okay. Okay, thank you.
All right, Victor, I'm gonna turn it back over to you. I'd love to schedule a follow-up anytime you want. I'm more than happy to. Please, everyone, take down my name and phone number and email. Reach out to me anytime I can help you with a quote. And I just want to say thank you very much for allowing me the opportunity to spend time with you today.
Okay, thank you. Thank you, Ken.
Have a great day, everyone.
Have a great weekend.
Thank you. You too.
Thank you, Ken.
Thank you. Bye-bye.
Bye.